Hello, in this lecture we will define goods in process inventory. According to Fundamental Accounting Principles, Wild 22nd edition, the definition of goods in process inventory is account in which costs are accumulated for products that are in the process of being produced but are not yet completed. Hello, in this lecture we will define goods in process inventory. According to Fundamental Accounting Principles, Wild 22nd edition, the definition of goods in process inventory is account in which costs are accumulated for products that are in the process of being produced but are not yet completed, also called work in process. Goods in process inventory, therefore, is a type of inventory account. It's going to be a specific inventory account to a specific type of company, a manufacturing company, a company that manufactures inventory. The reason we need different inventory accounts for a company that manufactures inventory and we do not for a company that simply purchases and sells inventory is because if we make the inventory, we're going to have to track the costs of that inventory, which will include the raw materials, the goods in process, and the end finished goods. We'll then sell it and record the cost of goods sold related to the sale of that inventory. For example, if we're a manufacturing company, we could start off with, in this case we're going to produce boats, the materials. We're going to purchase the materials. That in the end is going to be a boat, so it's kind of a form of inventory. It will be an asset at that point, but clearly it's not something that we can yet sell. Therefore, we're going to have to track the costs in this way. We're going to convert that raw material, hopefully, into a boat, and we're going to have goods in process once those materials are then transferred from the materials to the work site when we are actually working on it. And as we work on it, we are going to include not just the raw materials in that cost of that boat, that inventory to us. We are also going to include the cost of overhead and the cost of direct labor. So we got direct materials, direct labor, overhead now being applied in the goods in process. Once they have been completed, then we'll transfer it out to the finished goods. This is going to be the account most similar to a company that just purchases and sells inventory, in that the goods are now ready to be sold. Once they are sold, we're going to decrease the finished goods and record the cost of goods sold in a similar way as we would if we were just purchasing the inventory, marking it up, and then selling it to the end customer.